Gold has long been considered a safe haven asset, a hedge against economic uncertainty and inflation, and right now the gold market is flashing some very bullish signals. Factors like recession fears, anticipated interest rate cuts, persistent inflation, and strong central bank demand suggest that gold prices could be headed significantly higher in the coming months and years. In this video, I'll provide an in-depth analysis of the key drivers behind the current bullishness in the gold market. I'll explain why gold is poised to potentially reach $2,700 per ounce, and why any near-term corrections should be viewed as buying opportunities for long-term investors. I'll also cover the important role that central banks and high-net-worth investors are playing in supporting gold prices. Additionally, I'll discuss how the previous Trump administration's policies positively impacted the U.S. resource sector, including mining, and how a reintroduction of similar pro-industry policies could further bolster the gold market. Finally, I'll examine the implications of inflation and the Federal Reserve's actions, and how market sentiment around rising prices could influence the trajectory of gold prices going forward. So if you're interested in understanding the factors shaping the gold market and where prices may be headed, be sure to watch this video until the end. Let's dive in. The gold market has been exhibiting a decidedly bullish tone in recent months, and there are several key factors driving this optimism. First and foremost, the growing concerns around a potential economic recession have fueled increased demand for safe haven assets like gold. As recession risks loom, investors are seeking refuge in gold, which has a long history of holding its value during times of market turbulence. The yield curve has been inverted for several months, which is often viewed as a reliable recession indicator. Additionally, trade tensions, geopolitical uncertainties, and signs of a slowdown in the global economy have all contributed to this recession narrative. In response to these recessionary fears, the Federal Reserve has pivoted towards a more dovish monetary policy stance. After raising interest rates aggressively in 2022 to combat high inflation, the Fed has now started to cut rates, with more cuts anticipated in the coming months. Lower interest rates are generally positive for gold, as they reduce the opportunity cost of holding the non-yielding asset. Inflation also remains elevated, with the latest data showing that the Consumer Price Index (CPI) is still running well above the Fed's 2% target. Historically, gold has performed well during periods of high inflation, as it is often seen as a hedge against the erosion of purchasing power. Investors are concerned that the Fed may struggle to bring inflation back down to its desired level, which could prompt further rate cuts and provide additional support for gold prices. Furthermore, central banks around the world have been net buyers of gold, with non-G7 central banks leading the charge. These institutions view gold as a vital component of their foreign exchange reserves, and their continued accumulation of the precious metal has been a significant driver of demand. While some central banks have slowed their pace of purchases due to the high prices, the overall trend remains positive for the gold market. Given the various factors fueling the current bullishness in the gold market, many analysts and experts believe that prices could potentially reach $2,700 per ounce in the not-too-distant future. This would represent a significant increase from the current levels around $1,900 per ounce. However, it's important to note that the road to higher gold prices is unlikely to be a straight line. Periodic market corrections, where gold prices may dip, should be expected and viewed as potential buying opportunities for long-term investors. Even if gold were to experience a pullback, say to $2,500 per ounce, this would still be a favorable level for those looking to establish or add to their gold positions. The fundamentals underpinning the gold market's strength remain intact, and any near-term dips would likely be temporary. Investors with a long-term perspective should be prepared to take advantage of these market corrections, as they can provide an opportunity to acquire gold at more attractive prices. By dollar-cost averaging or making strategic purchases during periods of weakness, investors can potentially enhance their overall returns and build a more resilient portfolio. The significant role that central banks are playing in the gold market cannot be overstated. As mentioned earlier, non-G7 central banks have been net purchasers of gold, with countries like China, Russia, and India leading the way. These institutions view gold as a critical component of their foreign exchange reserves, providing diversification and a hedge against geopolitical and economic risks. While some central banks have slowed their pace of gold purchases due to the high prices, the overall trend remains positive, with central banks collectively adding hundreds of tons of gold to their reserves each year. Alongside the central bank activity, we're also seeing an increasing interest in gold from Western investors, particularly high-net-worth individuals and institutions. Inflows into gold-backed exchange-traded funds (ETFs) have been on the rise, as investors seek exposure to the precious metal as a way to protect their wealth and mitigate risk in their portfolios. The growing appeal of gold among this investor segment is largely driven by the same factors that are fueling the broader market bullishness: recession fears, inflation concerns, and the expectation of further monetary policy easing. As these high-net-worth individuals and institutions allocate more of their portfolios to gold, it will likely provide additional support for gold prices in the coming years. Another factor that could potentially play a role in the future performance of the gold market is the impact of policies enacted during the previous Trump administration. The Trump administration's approach to the resource sector, including mining, was generally seen as more favorable compared to previous administrations. Regulatory changes made during this period, such as streamlining the permitting process and reducing environmental restrictions, had a positive impact on the resource industry. This, in turn, bolstered the performance of companies operating in the mining and extraction sectors, including those involved in gold production. If similar pro-industry policies were to be reintroduced, it could potentially benefit the gold market by increasing the ease and profitability of gold mining operations. This, in turn, could lead to higher gold production and potentially put downward pressure on prices in the short term. However, it's important to note that the long-term fundamentals of the gold market, such as the factors we've already discussed, are likely to remain the primary drivers of price movements. Any policy changes would likely have a more modest impact compared to the broader economic and market forces shaping the gold market. Inflation and the Federal Reserve's response to it are also crucial factors to consider when analyzing the gold market. As mentioned earlier, inflation remains elevated, with the latest CPI data showing prices rising at a persistently high rate. Despite the Fed's efforts to rein in inflation through interest rate hikes, the central bank has now pivoted towards a more dovish stance, cutting rates and signaling the potential for further cuts in the coming months. This shift in monetary policy is largely driven by concerns about the potential negative impact of higher rates on the broader economy. Investors are closely watching the Fed's actions and are trying to anticipate how the central bank will respond to the continued inflationary pressures. If the Fed is perceived as being behind the curve in its fight against inflation, it could lead to a further erosion of confidence in the central bank's ability to control price increases. This, in turn, could fuel greater demand for safe haven assets like gold, as investors seek to protect their wealth from the ravages of inflation. Additionally, if the Fed's interest rate cuts result in a weaker U.S. dollar, it would further boost the appeal of gold, which is often viewed as a hedge against dollar depreciation. Despite the recent rate cuts by the Federal Reserve, inflation remains a significant concern for investors and consumers alike. While the headline CPI numbers have moderated from their peaks, core inflation, which excludes volatile food and energy prices, remains stubbornly high. This persistent elevation in core inflation is particularly worrying, as it suggests that the underlying inflationary pressures in the economy are proving more resistant to the Fed's policy actions. If core inflation remains elevated, it could lead to further erosion of consumer purchasing power and potentially prompt the Fed to take even more aggressive measures to bring prices under control. Investor sentiment towards inflation is also a critical factor in shaping the trajectory of gold prices. If the market perceives that the Fed is falling behind the curve in its fight against inflation, it could lead to a shift in the perceived value of fiat currencies, further boosting the appeal of gold as a safe haven asset. Conversely, if the Fed is able to successfully rein in inflation without causing significant economic damage, it could dampen the demand for gold as a hedge against rising prices. Ultimately, the market's assessment of the Fed's ability to navigate the delicate balance between controlling inflation and maintaining economic growth will be a key driver of gold's performance in the coming months and years.